Sales at U.S. retail and food establishments fell 0.6% in July, the first decline in 6 months. Economists had expected growth of 0.1%. Consumers pulled back, particularly on automobiles, which declined 2%, and gas station sales, which fell as gasoline prices dropped. The University of Michigan preliminary consumer sentiment for August fell to 51. After increasing to 55.2 in July, consumer sentiment at 51 is historically very low. For context, readings below 60 typically correlate with consumer behavior changes that slow economic growth meaningfully. This is not a minor wobble. This is a significant deterioration in how regular people feel about their financial situation. Why are consumers pulling back now? 3 things hitting simultaneously. First, cumulative effect of inflation that has been running above target for 5 consecutive years is finally exhausting household budgets. Consumer prices are 24% higher than 2021. Even as the rate of price increases slows, the absolute price level remains dramatically higher. Second, higher interest rates have increased the cost of every financed purchase. Cars, furniture, appliances, anything bought on credit costs significantly more per month than it did 2 years ago. Third, labor market uncertainty. The economy shed 23,000 jobs in July. When people feel their job is less secure, they cut discretionary spending first. The economic feedback loop this creates: falling consumer spending reduces business revenue. Reduced business revenue leads to cost cutting, including employment. Employment cuts increase consumer anxiety. Increased anxiety reduces spending further. This feedback loop is how economic slowdowns accelerate from inconvenient to serious. The broader question facing Wall Street is whether AI-related earnings growth can remain strong enough to offset pressure from higher interest rates, elevated energy prices, and slowing consumer spending. This is the central tension in markets right now. Corporate earnings, driven significantly by AI, productivity and efficiency gains, remain extraordinarily strong. Consumer spending, the foundation of 7% of the U.S. economy, is beginning to crack. Which force wins this tug of war determines whether 2026 ends in a soft landing or something more painful.